So we now have the final Bank of England base rate decision for 2023. December announcement was to keep the base rate at 5.25%. It's the third meeting in a row, September's meeting, November's meeting, and this one today, where there has been no change. And that followed, obviously, those 14 consecutive increases dating back to 2 years ago of December 2021, where the base rate sat at 0.1%, and that was the first increase in December, started bringing it up to where we are now. So 2 years of lots of increases, but 3 or 4 months now of no change at all. In this video, what I'll do is I'll take you through why the Bank of England has said it's kept rates as it is right now, what the markets and the analysts think this could mean for 2024, and also what it would mean for you right now and in the future when it comes to your savings and your borrowings, particularly mortgages. So let's start off with the decision today, why it was kept at 5.25%. Now, the reason the Bank of England has been increasing the base rate over the last 2 years to this highest rate we've had since 2008 is because inflation has also been really, really high. And interest rate increases are generally seen as the main way to bring down inflation. And you want inflation to be lower because inflation is how much prices are increasing. They've obviously been very, very high rates over the last few years. In fact, we were at double digits a year ago. So again, we don't want that. High prices are not good for us. It's not good for us as consumers. The Bank of England want the inflation rate to be at 2%. If you increase interest rates, two things happen. One of them, well, in theory, of course, again, there's some people who argue this isn't actually happening, but this is the theory behind it and why the decisions have been made. If you increase interest rates, people will suddenly think, well, maybe I'll put money into savings instead of spending it. Or if you've got a debt, that debt becomes more expensive and you're forced into spending more of your disposable income on your debt, such as your mortgage. Those two things combined mean less money is in the economy, which means people have to lower their prices, therefore, or even slow down, probably more accurate, slow down the increase of prices, therefore bringing down the inflation rate. That's the theory behind it, at least. But it doesn't happen instantaneously. So you don't increase a hike of the interest rate and suddenly see inflation drop like that. It can take years for this to come across. So this target of 2% the Bank of England wants to get, we are still way off that. It still could be a couple of years before we get to it. But they want to see whether the rate hikes so far have done enough to bring it down. And that is where the decision today, there was 9 people on the Monetary Policy Committee of the Bank of England. 6 of them voted in favour of doing that again. Let's just wait and see how inflation falls. Okay, the next announcement will be next week, and obviously there'll be another one in January before the next Bank of England meeting, which will take place at the beginning of February. So 6 of them wanted that. 3 people still felt that another increase was needed, and they said that last time and the time before that as well. So it's not like this is kind of a certainty, but some of them obviously still think more needs to be done. Some of them think we possibly have done enough. Some might think we have done enough, but some are still not sure about it. So that's where we are. That's why the decision happened today. What's interesting about this particular decision to keep it, though, there's more behind it. So 6 weeks ago when I gave you the update, I told you how the Bank of England said that, and in fact, they said the time before that as well, they expect the base rate to stay at a high level, particularly this level of 5.25%, for a long time, potentially until late 2024, 10, 11 months time, and then start to slightly reducing at the end of next year and in 2025 again. That was where they were 6 weeks ago, what they thought it might be. And that would kind of suggest, again, that when we come to talk about savings and mortgages, that would also have impact over at least 12 months' time. What's been happening, though, inflation fell slightly more than expected last month to 4.6%. And also there have been figures this week at the UK economy is kind of not doing as well as was predicted as well. And that would also suggest that too many hikes of the interest rate could push you into recession. So those things combined and other bits of data as well out there actually means the markets and analysts, they're actually saying that they expect the base rate to be cut much sooner and much faster than expected. So they're looking at maybe, they think we'll see a cut of 0.25% in May next year. So again, a lot earlier than the Bank of England were initially saying that they thought it might be. So in May of 2024. And they're also saying they think there might be 5 cuts in the year. So by this time next year, the rate could be down to 4%. The base rate may be at 4%. Some think even more than that. One of the big investment people, who was it? can't remember who it was now. They think they might be down to Goldman Sachs, that's it. They think it could be at 3.75% in a year's time. So even more increases going on. And that changed, those predictions come out today. Yesterday, they were thinking it might go down to 4.25%. So again, this is all very much a move-in feast. All these things both true and untrue at the same time. But that is kind of where the markets are currently thinking things could go. Now, there's, again, no guarantee to say these things always change. Something's nailed on, there's going to be an increase, there's going to be a cut, there's going to be whatever it's going to be. But something can happen, something can change. So this is just the latest thinking of it. But could well be that we do see rates fall faster and sooner than expected. Still not down to those crazy low levels that we've been experiencing over the last sort of 15 years following that sort of 2008 crash. But it's definitely coming down to that kind of 4% mark much faster than we expected. So what does this mean for your money? Let's start with mortgages. Obviously, if you are on a fixed rate deal at the moment, nothing is going to change. If you're on a tracker rate, nothing is going to change. If you're on a variable rate, well, probably nothing's going to change. So for most people, if you've got a mortgage right now, nothing will be any different at all to where you were yesterday, a month ago. What will change, though, is when you start looking for that next mortgage deal. So obviously, if you're on a variable rate deal right now, they are broadly most likely to be amongst the most expensive ones out there. So you might want to consider looking for a fixed rate or a tracker rate deal. Or you might want to sort of just hold off a little bit and see if those increases come along. If you're on a fixed deal right now, you want to be sort of thinking about 6 months before that ends. Can you lock into a deal at the moment, just in case prices go up? But make sure that whatever you get, you've got the opportunity to get out of that without any penalty, because it could well be that in 6 months' time, when your deal does finish, rates are lower as a result of these predictions we've got right now. We may well have seen some cuts which start bringing the price down. I absolutely would recommend, as I always suggest one of these videos, is to talk to a mortgage broker, get their sense of where things could be going. They obviously don't know, but they'll know certain products. They'll know the ins and outs, the flexibility that you might have with them. But yeah, broadly speaking, if you have a mortgage, the likelihood that we'll see cuts next year is good news for when you have to change that deal. For other borrowing, probably again won't see much difference at all with this. Really where this impacts would be maybe the interest rate on the credit card or the loan, or potentially the length of the loan or the fee, the transfer fee that comes with them. They have been disappearing over these sort of hikes we've had, but I wouldn't imagine there'd be too much difference going on right now. If we'd like to see the rates begin dropping in the next 6 months or so, or begin to drop in the next 6 months. Where we are seeing, though, some big changes already is in savings. And as I told you in my update, well, and all the 6 weeks ago, 12 weeks ago, when we had this first sort of pause and the second pause, and particularly so today, it really looks like interest rates on savings have peaked. Same as the base rate is likely to be going down rather than up. There's still a chance it could go up, obviously, but likelihood it won't. And likelihood that means that the savings rates, where they've priced in potential future cuts or future hikes, they're now pricing in future cuts. They are on the decline. They really are dropping down on notices and fixed rate accounts. Seen so many of those top rates disappearing. Like every day when myself and the team update our best buy tables, be clever with your cash.com/savings is where you go to find those. We are writing down a list of so many things which are going. Every day someone's pulled, 2 people are pulled, this rate's gone, that rate's gone. Some new ones come in and around the mix, but it's very rare to have anything, jumping in right at the top significantly above the rest of the pack. It does happen. We've seen Metro Bank over the last month introduce some market leading rates across a number of different types of accounts, but we've already seen them reduce their fixed ISA rate deals. And I wouldn't be surprised if we see their other fixes. And in fact, in their other fixed rate account, that dropped as well. The only one of theirs that's still table topping is their easy access account. Fixes are just really disappearing. So if you haven't already fixed money and you want to fix money, obviously by locking money away in a fix, you can't access it. But if you do want to do this, the way these predictions are going, it's unlikely you're going to see anything better. Doesn't mean you won't. You could find someone in the new year, a provider comes out with a slightly more competitive rate. So there is a risk of that happening. But broadly what we're seeing here, and that follows in with these predictions of all those decreases next year, and those rates all being pulled quite fast. Easy access rates, they have sort of rallied slightly. We now get with Metro 5.22%, which is better than you could have got 6 weeks ago. But again, that's the only one there. I can't imagine many others are going to come in significantly around that. In fact, some of the ones just below it have just reduced their rates a little bit as well. But they're variable rate. Easy access accounts are all variable. So I would imagine some of these lovely rates we've been getting will start to fall next. Well, when we get a rate cut, that's when we'll see those happening if we do get a rate cut. So quick summary for you. Although the rate itself has stayed the same, the changes in predictions on what could happen to the base rate in 2024 are quite significant, and we'll see that in our savings and we'll see that in our mortgages if they come to pass. I'll obviously let you know beginning of February, the next time the Bank of England do get together, what they say there and what the kind of predictions have they changed at all in that time. My name is Andy Webb. Thank you so much for watching. Check out these videos here for more ways to boost your savings.